revenue pays government, but the private sector's 130% of GDP in debt on top of it, or more, and in which case there's just not enough revenue to service the debt. That's kind of what I got to with this everything code thesis, and therefore there has to be a mega player in that absorbs all of one side of the balance sheet, which is the government, which has to be done by the central bank and the government.
Hey guys, welcome to Everyday Finance. According to Real Vision CEO Raoul Pal, a decline in the value of the US dollar due to new trade policies and rising international tensions may be the catalyst for a significant surge in Bitcoin in the upcoming months. President Trump has implemented a broad 10% tariff on all imports in a daring move known as the Liberation Day tariffs. For important trading partners like China, Japan, and the EU, the tariff is even higher, with a 25% tariff on imported cars. Global markets have been rocked by the announcement, and stock prices have dropped due to concerns about escalating inflation, slower economic growth, and a declining value of the dollar. Ahead of anticipated price increases, consumers are already scrambling to purchase expensive goods like cars and electronics. In the meantime, the cryptocurrency market has suffered a slight setback, with short-term drops observed in Bitcoin, Ethereum, and XRP. Raoul Pal maintains his optimism, despite the decline, claiming that these circumstances may pave the way for a significant cryptocurrency recovery. He identifies two possible tailwinds for Bitcoin, which could soon be viewed as a safer option in the face of economic stress and currency volatility: the declining value of the dollar and growing financial uncertainty. Pal, who is joined by Jamie Coots, argues that the chaos brought on by tariffs and inflation might not only cause temporary panic, but also spark the next significant wave of cryptocurrency adoption and price growth. Let's listen. Raoul Pal.
Today, the bond market moves one day and everyone goes, China's dumping treasuries. I mean, all the time.
Yes, I don't buy that, by the way, but let's just assume that China sells US treasuries and Japan will decide to do the same as a consequence of what's ongoing on tariffs. I don't buy it, but let's just assume that. I think the worst, quote unquote, worst case scenario would be that the Federal Reserve will have to step in with some sort of light yield curve control in such an environment, which ultimately leads to the same conclusion that the currency will be debased because they'll have to print dollars to avoid escalating tensions in bond space. So the layman terms conclusion of all of this is that the dollar that you hold at a bank deposit will be worth less over time as a consequence of the central bank bailing out the bond market. And I don't hold high hopes on behalf of the Doge project. I think it's almost impossible to bring the deficit down. Ideologically, I think
it might
give it a shot.
Some of the increase that's coming from the interest payments, but it's just slowing down the rate. It's not reducing it.
Yeah, and as we speak, it also kind of feels like Elon has thrown in the towel on that job to some extent. Even though you'll have to praise him for his efforts, but it's an impossible task to really change the trajectory of the deficit, in my opinion. So the point here is that we'll have to do something to avoid a scenario where interest rate payments just grow and grow and grow and grow as a part of the budget. And take a look at the Japanese case over the past 2-3 decades to get some sort of feeling of where we're headed, because Japan ultimately had to protect the yield curve. Otherwise, the budget would simply not, it would not be sustainable without it. And now we're seeing, small signs of higher bond yields in Japan. And as soon as that happens, it doesn't really work, right? The central bank always have to, either rhetorically or via market interventions, step in every time something happens in bond yields in Japan. And I ultimately think that we're moving towards, over the next decade or so, some sort of similar scenario in the US. And I think there's a lot of literature proving this. As soon as you're above, say, 100 to 120% of debt to GDP, it's the point of no return. It's very, very difficult to get back.
And because my view on that is, at a very simple level, GDP growth, annual GDP growth, is the income or revenues in the system that services the debt. Now, if the public sector is 100% of GDP in debt, and let's say interest rates are 4%, and let's say for easy maths, interest rates are at 2%, and the economy is growing at 2%, that's basically all of the economic revenue pays government. But the private sector's 130% of GDP in debt on top of it, or more, and in which case there's just not enough revenue to service the debt. That's kind of what I got to with this everything code thesis. And therefore, there has to be a mega player in that absorbs all of one side of the balance sheet, which is the government, which has to be done by the central bank and the government.
Yeah. And, if we look 5, 10, 15 years ahead, Raoul, as an economist, I think what's upcoming here is an incredibly interesting time for productivity. And, you and I just chatted earlier today around how solid an analysis of the current macro backdrop you can get from ChatGPT. It basically spits out the conclusions.
Raoul Pal has long maintained that President Trump's economic policies, especially his calls for loose monetary policy, aggressive fiscal spending, and tariffs, are a part of a larger plan that subtly devalues the US dollar. Trump has implemented protectionist trade policies, such as tariffs, since his first term in an effort to boost domestic manufacturing and close trade deficits. These policies frequently lead to retaliation, disrupt global supply chains, and raise consumer prices, even though they may be advantageous for American producers in the short run. Consumer purchasing power declines with rising inflation, forcing the Fed to make monetary adjustments. The national debt has grown dramatically as a result of Trump's preference for lower interest rates and extensive fiscal stimulus, which has further put pressure on the dollar. Pal claims that the combination of monetary loosening and inflationary pressures tends to devalue the currency, which ironically could work in favor of cryptocurrencies. Bitcoin's fixed supply and resistance to devaluation make it a better digital store of value than fiat currencies. Investors often use Bitcoin as a hedge when inflation rises and traditional monetary tools fail. Pal notes that Bitcoin has grown most during times of rising liquidity, like the 2020 stimulus rally. Even though recent tariffs have caused short-term volatility and lowered cryptocurrency prices, he believes the long-term macroeconomic climate of inflation, slowing growth, and a declining dollar is preparing Bitcoin for its next major upswing. If the Fed loosens policy due to trade disputes, capital may again pour into cryptocurrency markets, spurring adoption and price growth. Watch more.
It's now giving like probabilistic understandings, joining the dots, which I didn't think it would get to, the kind of macro dots. I mean, I showed you that ChatGPT thing. It's like, oh shit, okay, this is getting really smart.
Yeah, and in a few years, you and I will just have to entertain people. We cannot really add any value relative.
It'll just be drinks with Raoul and Andreas, getting shit faced. There's nothing else to do.
Exactly. Let's see whether people will pay for that, but hopefully so, right? But joking aside, Raoul, the point here is that in 5 years' time, an entity will be one person most often, I think, or two persons. We will have much fewer companies with a lot of employees, because you're essentially able to set up a company and get a lot of stuff fixed via AI instead of having an accountant and having a lawyer and all of that. To some extent, right? I'm just trying to think ahead here. That's a big productivity boost, because I can be a lawyer, I can be an accountant, at least if it's not too complex, right? And if productivity grows at a much, much faster pace, it's actually possible that GDP on a trend basis starts growing a lot faster than what we've been used to since '08. And that could alter the picture a little bit in terms of debt to GDP. What I don't know, and I'm curious to hear whether you have thoughts on that, is what happens to the workforce in this environment? Will we have to ultimately pay 50% of the workforce some sort of universal basic income? Or what will happen here? Or will we end up as solo entrepreneurs, all of us? Or
My view on this is yes to both of those, and also that we will adapt and find new ways. And you've said it, is entertaining each other, i.e. being humans. The humanistic things, whether it's music, that can be done by AI, but to be live on tour can't be. To be at a restaurant is valuable. To be on holiday is valuable. To be at a live event where you're meeting other people is valuable. To be communicating with people and just being a human, whatever that means. So I think that's where, and David Mattin talks a lot about this, is like, we're just going to have to lean into being human, because that's the only thing the AI can't be. The AI can't come into a room, give you a hug, say, how you doing? Let's have a drink, whatever. It can't do that. And that's a very human thing. So I just think we do adapt over time. The question is where do the revenues come from for the state? How do you tax AI? How do you tax, because a lot of this can be just agents. How do you tax them? How do you tax the robots? How do you bring the income side in to pay the UBI on the other side? That's not sure. While GDP growth could be 10% because of the insaneness of the productivity boost that happens. So you're getting massive GDP accruing to whom? Not clear. It's not large corporations employing 30,000 people. So, how the fuck does distribution of wealth happen? Does it matter anymore? I don't know. And this is why I came up with this idea of the economic singularity, where it becomes so much of I don't know anymore, that I just think I just don't want to be trying to make a living in 6, 7 years' time. I want to have made my living so I can observe it and not have to adapt. Young kids will adapt. But, even for you and I, 7 years' time, unlikely to adapt to the scale of what needs to happen. And so I just think we'd better be careful. Now, coming back into the current day, the pushback or the fears that everybody expresses are tariffs, it's the end of the global system, everything's going to break, it's recession, it's inflation. What is your mental framework for tariffs? What are they trying to do? Why? And what will be the likely outcomes?
So, at least for now, Raoul, it looks to me like they're actually expecting to get some revenue out of these tariffs.
That's right.
And that's a newcomer in a sense, because initially I thought that reciprocal tariffs would lead to some sort of race to the bottom, and the whole purpose of it would be to, create a race to the bottom. Because if you add reciprocal tariffs on Indian exports, they would have to get rid of their very, very high tariffs on US imports, right? But as of now, it doesn't really look like that's the game plan. So I have to accept that I need to change my thesis a little bit here. And what we do know, Raoul, is that even though we ultimately end up only entertaining each other in the future, we'll still have to eat food that crosses a border. And I actually think it's a decent revenue source for the government to tax that banana moving from Nicaragua to the US.
I live in the Cayman Islands. We don't have taxes, but we have import duties, which are tariffs.
Yes.
The trade war has significantly escalated since China announced a 34% retaliatory tariff on all US imports, indicating that tensions between the two biggest economies in the world are about to enter a more unstable and uncertain phase. The geopolitical stakes and widening economic gap are highlighted by Beijing's harsh denunciation of the US policy, which it describes as unilateral bullying and a violation of international trade standards. Global markets are now preparing for more volatility, supply chain interruptions, and slower economic growth as a result of both sides being trapped in a tit-for-tat tariff spiral. Cryptocurrencies like Bitcoin could be useful as alternative assets in this unstable environment. Crypto adoption has historically increased when macroeconomic shocks shake traditional markets and investor confidence in fiat currencies declines. Faith in centralized monetary systems may be further damaged by the ongoing trade tensions, particularly if they result in inflation, depreciated currencies, or overreactions by central banks in their policy. Digital assets may be seen more and more as hedges against economic volatility, especially those with a limited supply like Bitcoin. As both institutional and retail investors search for decentralized stores of value outside the conventional financial system, this geopolitical rift may hasten long-term adoption, even though short-term volatility in cryptocurrency markets is likely, particularly given liquidity pressures. Thanks for watching.